Good morning, everybody. Welcome to the Flow Show. Friday, once more, another week passes under the bridge. Morning, Kay. How's it going, mate? Time's speeding up for you.
Good morning, Ryan. Good morning, everybody. Yeah, I'm glad it's Friday. Let's say, and very ready for the weekend.
Yep, very much so. Very much so. Looking forward to it. I want to say a welcome to any new viewers we have today. I've met a few people at an event in London yesterday and got speaking to a few and tipped them to come and watch us on the Flow Shows. Hopefully we've got a few more viewers coming in. Good morning to you if you are joining us for the first time, and good morning to you if you've been here, if you're old hands who've been coming here for a while. Always a pleasure to see you all here. Right, let's have a look and see what's rocking and rolling in markets. Obviously, the big event overnight was that Israel retaliation, which we'll touch upon shortly. We'll kick off with a bit of data. That Japanese CPI data largely coming in around expected numbers. Was a little bit softer on the core, 2.6%, but the national CPI coming in as expected, 2.7%. We've also got the core, the ex-fresh food and energy number, which was also lower than expected at 2.9% versus 3% expected and 3.2 prior. So a little bit of a movement the other way. Probably not going to be a problem unless it really starts dropping, getting down under 2.5%, those sort of numbers. Then there will be questions asked over Bank of Japan's policy. But we should expect a little bit of two-way movement on inflation. Finance Minister Suzuki was still had still been waffling away at yesterday's G20 IMF stuff. Said that FX wasn't on the G20 agenda and that he didn't mention FX personally. But we did know that it was part of the G7 stuff that came out. And he said it was meaningful that the G7 confirmed the commitment that excess FX moves have a negative impact on the economy. He said some G20 members mentioned how high US rates could lead to fund outflows and a rise in debt interest payments. Ueda was out as well, saying he sees a chance a weak yen may affect trend inflation, and if so, that could lead to a policy shift. So as we've been monitoring, they're moving into a bit of a Draghi line, and how some of the other ECB members have been talking about FX and its impact on things like inflation. Over at the Riksbank, Janssen said he's feeling significantly more confident in the inflation outlook. BOE's Green says core services inflation is encouraging but still too high. Services inflation and wages are also elevated, but says doesn't think a rate cut is imminent, so we won't be seeing her tick or her vote going over to the cut side just yet. Says UK will import inflation via a stronger dollar. We got UK retail sales this morning, which were a bit on the soft, flatty-ish side, depending on how you want to look at it. Retail sales on the month came in flat, were expected to rise 0.3%. Year on year was better than last month. Core sales were down though, so that wasn't too good, but nothing gangbusters from this. It's been a bit up and down of late, so we haven't really got a big trend developing yet. It is looking a bit more to the soft side. Over in Germany, things are sounding a touch more upbeat. Bundesbank in their monthly report says that the economy probably grew in Q1. It says the economy has brightened but is still weak at its core. It's unclear if GDP will expand in Q2. Well, it looks like the German government might have taken those words to heart, because they're expecting GDP to grow 0.3% in 2024 now, up from a whopping 0.2% previous forecast. They've done nothing but cut their growth forecasts over the last few months. So for once, we've got an upwards revision. ECB's Nagel says we can't rule out small rebounds in inflation in Germany in some months this year. It says US data or US inflation data shows that caution is warranted, and that discussions on what happens after June, the potential cut, are premature. It's not premature for ECB's Villeroy, who says he's open to rate cuts at each meeting after June. ECB's Simkus says he sees about 3 rate cuts this year in his baseline scenario, most likely to have several cuts, but ECB doesn't have to be precise, and says it's not in a rush. ECB is not increasingly confident about the disinflation progress, not uncomfortable with market pricing of rate cuts, and also says that euro depreciation would contribute to import inflation. Hawke Holtzman is hesitant, or says a hesitant Fed limits the leeway on rate cuts, similar to comments he made the other day. He says he can't see 3 to 4 ECB cuts this year without the Fed cutting rates. He urges caution after potential first rate cut. Says there's likely to be a majority for a June cut, and says that the ECB couldn't look through potential oil price shocks. Ollie Wren, euro area wage growth is moderating. Geopolitics could derail the improving euro area outlook. Time will be ripe in June to start cutting rates. ECB's Pancetta says disinflation is advanced and continuing. Said the ECB will consider the level of restriction. A tighter Fed is empirically a form of tightening for the euro area. ECB's Wojcik says so far the Forex market has been calm about the risk of Fed ECB divergence. And ECB's Cicluna says we may need 50 basis point cuts if inflation is set to miss 2%. Okay, my question to you is, we're getting a lot of ECB members now bringing up the FX subject. In a lot of ECB members, or in fact everyone, seemingly Japan as well, talking about how things are tied to Fed rate cuts. I don't know why they don't just give up this talk that they work independently of Fed and just peg their rates to the Fed's rates.
Yeah, maybe we are looking at a merger between the ECB and the Fed. No, I think it's more a case of there's so much going on about those yields in the US staying higher for longer. The Fed members also talking about higher for longer. And in the case of the ECB, I think it's something along the lines of we're afraid that the dollar is going to put in another 10% rally, and then that's going to make our job a lot more difficult. And I think that's what mostly has to do with all of this. Of course, if the currency goes down versus the dollar, seeing that the US is a big trading partner, they're going to import more inflation. So I think that's basically what they are talking about, I guess. Just the being afraid of what may come. We've seen the dollar, advance regularly versus other currencies. Euro has been, yes, the dollar is stronger, but the euro has been relatively stable. Yes, we've had a big move over the year end, a big move over the start of the year, but now it's euro is lower, but I mean it's not really falling out of bed, right? We're still above 105, 106 even. But I really think the reaction of those people are like, be careful, because that's the other thing. And you know, I spoke about this on one of our shows already about the yen. Imagine that they start to intervene and they are on their own, and then we know that PBOC is trying to keep the dollar China in check. We know Korea is trying to keep the dollar China in the dollar yuan in check. So I think some of those central bank reactions are based on what they fear. Because if let's say Japan does something like really forceful and stops the yen from depreciating, the market will turn around. Still looking at those dollar yields, the resilience of the US economy, and say like, well, if we can't buy dollar yen anymore, we need to buy other dollars. And then you're probably going to see, after the intervention effect, which may happen on a lot of dollars, you will probably see a flight of dollars into other currencies, under which, for as long as these green shoots remain like very small shoots in Europe, the euro could start to suffer. And I think it's all like a reflection about what may happen in the future if the dollar continues to rally. I don't think that today really they see it as a problem, but yeah, they will always keep an eye on FX. But you know what Lagarde said already at the start of her tenure, and even former central bankers, the currency has to move 10% to impact inflation for relatively little still. So we still have some ways to go, I think, before it really gets painful for the ECB.
Yeah, very much so. But you know, we heard Powell when he was having his little chinwag with Stiffers, you know, saying that they understand that what they do with policy affects the rest of the world, and we know, yes, they are all in cahoots with each other. They all know what each other's going to be doing and when they're going to be doing it. But is there a possibility where there might become a bit of friction? You know, if the dollar does move significantly because Fed are keeping their rates higher for longer, does it become then a bit of a problem because, you know, the Fed will have to turn around at some point and say, well, you know what, it's tough luck. We need to do policy for the US. So irrespective of the impact on you, if it becomes too negative, does that then become a bit of an issue, or does it get
Further down the line? I of course, I mean, it can always become an issue. And perhaps they think about this potential issue, but now I think then you're looking at perhaps the end of the year. Are they perhaps already afraid that we may see a Trump re-election and him replacing Powell with somebody who will say, "It's not my problem, it's yours," and perhaps they're already thinking about it. You know, Lagarde already spoke about that earlier this year or late last year, that she says like we may be facing a bit of issues if we get a Trump re-election, right? So yeah, perhaps it's in the back of the minds that is a possibility indeed.
Yeah, but for everyone watching us today, you need to know we're not talking about a couple hundred pip moves in the dollar here. We're talking significant dollar moves that would then make it become a problem. Yes, they're jawboning it a bit at the moment, but you know, as we've been looking at the chart, we're not busting any sort of huge moves. We're not seeing the likes of stuff we saw in the early 2000s, that sort of volatility, and you know, stuff around Draghi and the GFC and all that stuff. So yeah, things are pretty stable. Even if we moved up to the 120s or, you know, down to the 95s, yeah, still big moves, but probably not types of moves that are going to get a real massive response. But you know, each time is different, so we'll wait and see.
Look at those moves that we had since really 2023, right? We've been spending a year, over a year in a 6-7 big figure range, which is one of the smallest ranges in history, actually, in the euro dollar. So
yeah,
it's not a problem for today, but it might become one towards the end of the year if the dollar continues to rally, because if you look at it, I think it's relatively stable versus euro, for instance, even stuff like sterling, and now we've had our correction of the big down move in dollar Swiss, and dollar Swiss is relatively stable as well, barring those nasty spikes that we saw, for example, overnight.
Yeah, very much so. Okay, doke. Well, let's move on to some of the other news. And where am I going? I lost my place now. Yep. So over on the US side of things, we had a bit of data out yesterday. Philly Fed, which came in quite positive, a bumper 15.5 on the headline number, there. So showing a slightly different outlook to what we saw from the Empire. And as we've been saying, that Empire data's now just becoming a bit of a volatile mess. The components are in there. Employment was a bit softer though. Prices paid were higher. So we're potentially maybe seeing some job weakness coming in, or further job weakness in the manufacturing sector, which won't be too much of a surprise, but a bit of a jump in those price components there. New orders was up as well. CapEx down a touch. Jobless claims, same old, nothing to see here. Numbers staying pretty steady around that 200k, 250k area. Continued claims around that 1.8 million. So all fine and dandy over there. Existing home sales were a tad softer as well, down 4.3%, coming in at 4.19 million. So missing expectations by a pip, and down on last month. That's a second of the main housing data numbers showing a little bit of weakness there. Again, need to see if that develops into something. Feds Williams was out again, and it seems like every time he speaks, he just changes a little something that takes him into the bit more hawkish side of the path. He doesn't feel an urgency to cut rates. Eventually, interest rates will need to be lower. Rate cuts will be determined by activity. Rate hikes are not his baseline forecast, but if data called for higher rates, the Fed would raise rates. Fed's Bostic says we won't be able to reduce rates until towards the end of 2024. It said, I have to be open to increasing rates if inflation stalls out or goes in the other direction. If inflation falls more rapidly than we expect, we may pull forward rate cuts though. Kashkari, we can wait as long as it takes before cutting rates, and could potentially wait until 2025. Another lot, K, they're all just, I wouldn't call it changing, but they're all just starting to cover their asses, aren't they, in case inflation starts going up again.
Right, that's the thing we've been talking about. They don't want to make the mistake on that side of the balance. I don't know. I mean, yeah, Williams is changing words here and there. We can call it evolving or just not knowing what to say anymore. Different than what he said before. Yeah, I think it's just like, yeah, we're higher for longer, and now we have to wait. I still think that the bar for a hike is high. It's what I've been saying already a couple of times, and also what Powell was hinting at during his little chat with Steve in the other day. I think it's clear the bar for hikes are relatively high. But yeah, they will be forced to stick for a bit longer now. And this being said, when we spoke about that with the guys in our flow room yesterday as well, it does still occur that perhaps take away Kashkari and one or two others, that is not going to need too much of a weak set of data to bring the cuts more back closer to home. There's something like underlying, and actually it appears to me that the market is yes, the rates are higher, but the dollar is less advancing, and we're actually seeing like people going into different instruments as well. It does seem that the market is always ready to the first set of bad data, expecting the Fed to turn again and bringing those rate cuts slightly forward. And that does seem to filter through a little bit, because you see those moves that we had over the past few days again, with rates going up. Euro dollar is still holding 106, you know. The yen is a different issue, right? And even the Swiss in a way is a different issue, because we saw a big swing on the geopolitical thing. But if you look at stuff like the near ones, the euro, sterling holding up around 124, Aussie not well. Yeah, we had again this geopolitical scare, but then you wake up and it's back above 64 again. it does seem to me that, and I would actually, and it's not for today, but I may start to lean towards that side as well. It does feel like they don't want to make the mistake, so they stay higher for longer, but get a bad set of data. They could really easily bring it closer to home as well.
Yeah, no, we know how that pendulum swings, most definitely.
And
I think
and
if
and you know what? Those interest rates, you know, we are trading very close to 5% on the 2 year. If assuming that they hold rates for a bit longer, they are now at 5.25, 5.5. Your top end, if we assume that it's going to be a high bar for raising rates, your top end should really be in the next 35, also 40 basis points, right?
yeah,
Around this 5.35, max 5.5, if we see an overshoot perhaps on some inflation also data. But I think again, and that's what I've been saying from the start of the year as well, I think gradually, I mean, yeah, the inflation can remain a bit more sticky, but the rest is going to take over. And that's why I'm saying, like, get a bad NFP and then look at how the pendulum can swing on rates as well. And I'm starting to be a bit cautious for all of that right now.
yeah, and I said it last night. This event, you know, it's still at the back of my mind that you can't go from zero or near zero in rates to 5.25 or whatever so quickly and not have an impact. It's been really strange not to see a significant impact from rates for the US and for a lot of countries as well. You know, yes, no one's slammed into the wall just yet, although, you know, Europe's dragging along the bottom. The UK's been dragging along the bottom. So that's probably part and parcel. But to have the US outperforming in such a situation is still a very strange situation. And it's either one where there's either something brewing behind and we are suddenly going to hit the wall, or indeed we get a soft landing of the like. But yeah, on the inflation front, my pivot level for EC for central banks is 3%. You know, if inflation is below 3% in all the metrics, cores and whatever, then they're going to be leaning towards a cut side. But conversely, you know, Fed inflation's just CPI or US CPI hasn't gone anywhere for 10 months. But if it starts creeping up above 4, maybe to 5%, that's when I think the pain level starts to be felt, and that's when you start to get some real hawkish repricing, and maybe the Fed, you know, leaning a bit more towards hikes. But otherwise, I'm the same with Kay. I think there is a high bar at the moment for further hikes, but as we know, it might not stop the market going that way anyway, as it likes to do. But
that's the
yeah,
thing.
mate.
Perhaps not at the end of the extreme of the swing, because we have to acknowledge that the data right now are defying the laws of gravity in the States, right? So we're perhaps not completely at the end of the the pendulum swing, because also like one big investment house, Vanguard, not to name it, is saying that the 10s could actually go back to 5%. It is possible. Will it push them to hike? Really? I'm still not so sure. Okay. I might be, there's no more hikes.
Yeah, but no, you're quite right. I think we have had a little hawkish reprice, but we're not gone to extreme levels yet. And when we do go to extreme levels, that's when the trade for a fade might be the best way to go about it. But we shall see. We shall see. Right. So over to this Israel-Iran stuff. Obviously, there was lots of threats and counter threats banded around yesterday, and then Israel decided to act. A couple of things here. Firstly, they seemingly gone against what Biden said. Biden was basically said that you know, after the Iron Dome thing, they'll take that as a win. They did their thing. Iran did their thing. Let's move on. Israel decided to retaliate anyway. By and large, it looks like another for show type attack. You know, there was lots of talk about would they target nuclear facilities and the like. Instead, they targeted an airport and an air base. One of the air bases apparently was where a lot of the drones got launched towards, or where the command center was for the attack on Israel. So we've now had a response from Israel. Iran have been playing it down a bit, which is good. There's probably, I'd say it's probably a 70-30% chance that that's now the end of the saga in terms of lobbing stuff at each other. They've both done it. They've both publicised it. They've both gone back to their own populations to say we've acted and retaliated and whatnot. Let's hope that it calms down now. We're probably going to get a war of words for the next God knows how long, or continued. Risk trades did the same thing pretty much as it did with the Iran thing. We had a little pop and then it's all come back down again. So we're back to where we started. There were a few funky moves. I mean, I saw this morning. I was like, what the? This dollar MEX really went for it last night. And I thought, well, that might just be an errant broker feed, but I've checked it against the futures and some of the other markets, and it's a good move. It's a good price, but a real clean out in that one. That was probably the most surprising. Gold as well, that went up. Let's come down again. So we're hoping that this is the end of it. Kay, do you think we're over the worst of that particular saga now?
I'd hope to, I hope I can think so. It's surprising as well, because yesterday Israel was saying that they would wait with a bigger retaliation until after the Passover.
Yeah.
And yet they sent out some flying objects, as Iran called them, drones.
I was thinking about that as well, and that's another reason why I think it might be over for this part, because if they'd have kept it until after Passover, that's a whole 10 days. Everyone's going to be waiting on tenterhooks for something to happen. Get it out of the way now, call it quits, go into Passover, have that peaceful time where it's unlikely Iran's going to retaliate on a religious holiday, and that's maybe part of the way to get over this particular hump.
Perhaps, and let's hope it is the case. So apparently there were drones, right? And they weren't, well, I mean, of what I read, and of course we don't know exactly how many flew over, but it wasn't even that many apparently. So it looks more like a no, we are here kind of thing. They were sent into the direction of those nuclear facilities, but haven't hit any of them, I guess, of what we can read, at least. So yeah, let's hope the worst is over for there. They were very strange moves, and I think there's two outside moves that happened. So okay, dollar yen as well went down a big figure, but the big move on the mix is really, I think, a case of you're in Asian time. There's nobody in the Mexican peso. There is zero liquidity, and the machines and people have stops because of the market being long makes for the carry trades and stuff, and they just went into all of them. And machines don't think. It's not like if you have a human being sitting on a desk. I mean, if it would have been for just human traders, we would have never traded 18. I mean, I don't think so, because in the Swiss we would probably haven't been traded. Did we trade? We traded below 90, right? On the dollar Swiss. No, just above 90. But we traded well below 96 on the euro Swiss, for instance. So I mean, those are really outsized moves in an Asian time zone again. Again, on the MEX, I think that there's a lot of people who are going to call up their banks to see if it's possible to cancel some trades, as has been happening before. But what we need to take away from that is that it's the proof that those positions in the MEX were quite sizable. So there has been this big move, and on the Swiss as well. It's a case of stop losses. I really think I don't think that there's any, barring some speculators quick in and out. So I don't think there's any fresh positions there going long Swiss or short mix or in that. It's just a case of machines just grabbing the liquidity where it is. If you got a stop loss at let me say 1750, but there's no offers between 750 and 60, you just go and pay 60, 65, 70, and that's how it seems to have gone there.
Yeah, one of those moves where you'd love to have been sitting in front of your screen for that one, just to maybe have a go at knocking it on the head.
Well,
but,
yeah, I did get stopped out of my my Swiss positions, and luckily for me, the rates were pretty okay. Well, I've been scalping in and out of them for the moment, but yeah, those are the days. You know, yesterday I spoke about it, I think on the Flow Show, but I especially spoke about it on Face that I was running very reduced positions. And just to repeat for our retail trader audience and people perhaps not having that much experience yet in the market, those are the days where when you say that you're unsure, it's unnecessary to have like big risks running. So I've been knocked out of a couple of positions, but they don't really hurt my account. My account says thank you because I was reduced, running very reduced risk yesterday. So that is that's that story and a little bit of a how shall I say? I'm not overly stressed about it.
yeah, no, very much. No, a lot of people in the same boat. You know, speaking to our mate Mark in the chat room, same thing. He's not running an awful lot. I'm not running an awful lot at the moment. It's a mixture of market uncertainty, just what it wants to do after all these dollar moves and all these risk events. You know, you get knocked out of positions, and you have to just maybe sometimes have a reassessment period. You know, stocks are another one. S&P, you know, took an absolute battering all the way down. Let's put my lines back up. All the way through the 50 handle, all the way down, or the 5,000 handle, nearly down to the 49 level. We pull up at one of these, that small level there, 49.20s, 18.20s. So far, though, we're limited up to this 5,000 level on a bounce. Bounce has been pretty strong, and I'm speaking to someone on Twitter who managed to grab along at 49, I think, and thinks it's going to close above 5,000. It's very possible, but risk moves aside, the sellers are in control now. We had this break yesterday of this zone here, and by and large, it's held. We had a little nose above it, but that didn't last long, and down we come. And yet that move smashed us through the 5,000 level. We climbed up here. Sellers are going to want this to close below 5,000. All those ones have been trying to sell it all the way up. Now have got something to get their teeth into. So I think this is going to be an important level for today, where we close out the week. Do we close above 5K or below 5K? And if that's the case, then maybe we're going to get a test of the 38.2 fib and this other zone down here as well. What do you make of this one, Kay? Are we?
Yeah. That's the thing.
I mean, in control.
Oh, I'm really in between two seats, because if we assume or imagine that it's a one and done, this thing could close 50-50 or 50 closer to 51 tonight. If the market thinks that the stress is over and that was the worst, remember what happened last Friday? We sold risk the whole morning, spilling over into the New York morning, and then we had like this big ramp higher in risk, and gold lost $100, right? Before the week was over. That's all very possible. I think if for those who managed to catch the lows, I think you have relatively decent levels now to look at. I wouldn't go and chase it, but I really wouldn't be surprised to close at really virtually any level. Honestly, I think for instance, yeah, on the S&P, what was the level there? 50, 25, 35. That you were looking at, or 50, 30, 40 or so the other day? Yeah, 50, 40.
40, 50, yeah.
If we close above today, if that's the risk, if if we hear one or two more lines out of Israel and Iran that they say like, well, okay, we are done. Why not? This is because we don't have any data anymore today, right? We have a few
Yeah.
more speakers, but we heard so much about all of them. No, we don't. We don't have any US data anyway anymore today. So yeah, I mean, it's all going to be about who manages what and what risk wants to do before the end of the week and what positions people want. Because if those who are now short risk, if you look at the other side of the medal, those who are now short risk, they say like, well, what happens if it goes back above 5,000, 30, 40,
Yeah.
that's going to be the other side. So for me, personally, I'm going to really run into the weekend again with reduced risk, but reduced risk in FX. I'm not really planning on doing actually much before the end of the week, and then next week is another week, and we start again. If it stays quiet over the weekend, we probably are going to trade a bit higher in risk. Things are already starting to move gradually that way. If you look at Swiss pairs, they are gradually getting back what they lost. If you look at the dollar yen, we are nearly back where we took off from. So yeah, that's it's everything's possible today. But if I would not like, I would actually lean more towards risk coming back a bit better into the end of the week.
Yeah, no, that's actually a very fair point. And I know you just said you don't fancy chasing it. I actually might have a little chaser here. I don't know whether to see if we get another dip in S&P or just maybe buy a break of 5,000 if it starts to hold on the sort of 15-minute chart. Because I think you could be right. I think we could see a similar situation when the US comes in. Don't know, maybe a little short on gold or something. I'll have to have a look at that. I think that's a fairly good point you make there.
There's one thing today as well, and if I'm not mistaken, because I'm not a big follower of those things, but I wonder if there's not an OPEX in there as well today.
Yeah, that's true. There we go. S&P's just tapping on that 5,000 level right now.
Yeah.
I'll keep an eye on that one. It's also the last day for Fed speakers before they go into their quiet period. Thankfully, no more waffle heads until the next FOMC at the end of April, beginning of May. So that's a piece of good news for us anyway. Right, Kay, did you want to have a little look? I was obviously off yesterday afternoon, so I haven't done much on the old trading front.
Sure, mate. I actually, of course, a lot has happened, but where we are now, we are nearly back to levels. So let's have a look at the majors, shall we? And if you guys want to look at something in particular, I'm more than happy to look at it today as well. We've got 8 minutes, so if you want me to look at something, I'm happy to do so. Euro dollar and euro dollar, we've just scraped back up to where I have a little bit of a trend line, this intraday trend line, and could we be building, being a bit of a head and shoulder scenario here, in which case 106.65-ish is going to be not too unimportant to close the week, I would say. But that's to take with a pinch of salt, because we've been moving up and down quite a bit of late, and we have to acknowledge that 106 is still holding. Okay, so I'd say watch that little 106.65 for a starter, and then on top we are going to start to talk about 107 and those levels above, 107, 107.15, 107.30. But keep an eye on this one. If we start to break below 106, something is happening more on the dollar. We have seen that even in the scenario that S&P would start to rally, for instance, rally back higher, algos have a little bit of an impact on the FX market, the correlation algos, but not always. You know, we have to take the dollar and the equity markets 50% of the time separately from what's happening in one or the other market. Okay, so I wouldn't bank on trading dollars on the back of equity markets. Cable, bit of a similar situation. It's coming off gradually. This could be a bit of a pause before another move lower. But again, if risk does well, sterling tends to be a bit of a risk currency, so it might just hold up. This is the scare move overnight. I would still watch 124 figure 5 as a support here. And on the top side, keep an eye on what's happening in this, let's call it 60-75 zone. We crept up above 50, just didn't reach that 60-75 zone. But I'd say, like, keep an eye on what's happening here. But really, again, I'm in reduced risk mode. Okay, I'm a tad short on the cable, but I'm not gonna get married to it. If this goes, I buy my little short back before the weekend and call it a day. You know. On the other side, if the dollar keeps its bit bias, which fundamentally seen would be the logic, I think we can ultimately have a move or a look here at this 61.8 around in the mid 123s. Yeah. Yen, not a lot to say. Still the same picture. We did stop, but I think it's more coincidence than anything else. We did stop on this extension level. I said this 153.60 would be perhaps a bit of an intermediate level. It stopped right there, but you know, when it's geopolitics at play, those especially those kind of extension also levels, I don't think we can really bank on it, but it has created the level now, in my opinion. So when we get back, if we get back down there, that is a possible level that we need to keep an eye on. I think for the more medium term, we have to get back below 152.60 and below 152 to turn that ship around in a natural way, if it wouldn't be for interventions. So those guys, Ueda is still in Washington. He has a sit down with Adam Posen from PIIE tonight. It's 5 p.m. Eastern time, I think. So he's still in the States. But as I was saying on the chat as well and on the meetings, I do think that there is this window of risk opening for the yen. Okay, we clearly know that they are not happy about how the yen reacted. We know that Ueda repeated, although we saw the Japanese CPI slide a little bit lower. We know that this is the second time that he talks about the currency versus inflation. I'm not going to say it's still not my base case, but I am not going to totally rule out if we run into the next Bank of Japan next Friday and we're trading 156. I'm not going to completely rule out another hike just to officialize the 0.1%, the 10 BPs, for instance. I'm not going to completely rule it out, and I think next Friday is going to be a super important day, because we not only have the Bank of Japan, we do have the Tokyo CPI. Those guys are going to be fully back into the seat. If in the meantime the dollar hasn't lost any more of its shine, we are probably going to trade 155. Why not closer to this next extension level in the 156? It is those famous 10 yen that Kanda was talking about. So a lot of things can come together towards the end of next week. So I've had no cash. My call, my 150.5 call expired yesterday, so that left a decent life. Although I did pay a bit of pips away on the hedges carry over the last days, week, but still a decent ride. And I did buy just a punt, you know, a small put into the end of the month yesterday. The reason why I'm doing options is I don't want to run short dollar yen nothing happening for another week, and we're trading 155, 156, or even 154.5, and I'm already spunking money away for the carry. I know that I pay this carry away in the option premium, but having a lower strike prevented me from paying away too much, and I'm only going to risk my premium. That's why I'm trading all those options in stuff, especially in stuff where there's carry involved and where there is quite a big risk coming up. I prefer to pay away some premium than sitting here trying to sell dollar yen at 154.5 and then looking at a possible 100 points against me. If I buy an option, I'm just going to sleep much better. So that for the yen. Now I want to look at those Swiss pairs again, because we had this drop. You know, I've been talking about this 96.75 level on the Euro Swiss. Until yesterday, it held. Until overnight, it held really well, because yesterday we were trading above 97 again. Quite relaxed, actually, market yesterday, relatively relaxed market yesterday, and then we had this washout. Now we came into the second zone that I was watching. I've always talked about this second zone as well, until down in the 95.5. Again, same as on the dollar yen. I think pure coincidence they stopped here and then rallied back up. Coincidence in the price, not in the move. But we are, in the meantime, back above 96.75. So although it's a very tiny one, I'm trying back into a little bit of a long. I've actually have like both on again, a little bit of Euro Swiss and a little bit of dollar Swiss, which I put on actually at the start of the show right here. Just trying to trade the level again. I'm going to keep it very tiny, so I don't have to put a stop too close on it. It's going to be a disaster stop on this one. If I put a stop over the weekend, which I actually may not even do for once. Don't do this at home, but for once I may just leave it run. Because assuming that things are going to quiet down in the Middle East, there's no reason to be long Swiss right now. Yesterday we had one of those Swiss bots talking, and they still seem very happy that their Swiss purchases into the end of the whole of last year, from the end of 2022, have done their job. So they still seem pretty happy about it. I don't think that from the S&B side we have to be scared about anything. Dollar Swiss also broke back below the broken trend line, came into the 38.2, into those prior lows, but did not put in danger the more medium-term support. And we are now trading already well back above this 90.5, 90.70. I think in a I'm calling it a natural way. If nothing geopolitically disastrous happens, I don't see too much of a reason for it to crap the bed until we see something different in the dollar, on the dollar side of things. I don't think the Swiss is, barring geopolitics, a driver for much right now. Again, we spoke about those levels on the Aussie. Aussie came actually down. There's another trend line here. We came actually down very, very close to this trend line, 63.60. That may be your Trump line if it starts to come down again. If we break back down below 63.90, that low here may be a bit of a target. On the upside, I'd still watch 64.5. I know this trend line is coming down, but lines have only the force of looking nice on a picture. You know, I still think the level here for a close of the week is 64.5 rather. And on the Kiwi, it's the 59. On the Kiwi, it's 59 again. Trading back below. Again, we're trading below the channel again. That may be of importance, but it's also very close. It's 58.90. So 90 figure on the Kiwi is the level. If we start to close above the week, above 59, the figure, it's possible that we get back up to those levels around 59.5 as well before reassessing what's going on. But right now we had a bit of weakness of the dollar during our morning. I think it's more just that repositioning, that risk on and off, more than anything else. But the fundamentals remain what they are. I still think that over time, the dollar should continue to do well for a little while longer. But as I've said before, I'm also starting to get ready for if those numbers start to turn in the US. And with that, Ryan, back over to you, mate. And I wish everybody an absolutely splendid weekend.
Thank you very much, mate. And thanks for that note there, Patrick, that Japan took a small amount of dollar swaps this week. We know they've got the swap agreement still ongoing. I had not been keeping on top of that, so I don't know what's gone on. But yeah, we'll keep an eye out for that one in case it's something we need to know. But other than that, I'm just going to echo what Kay said. Have a wonderful weekend, everybody. Thank you for coming to the Flow Show this week. And as always, all weeks, have a great rest of day and enjoy your weekend. Get refreshed. And we go to battle again on Monday. Have a good one all.